Good morning, everybody. It's Thursday, the 5th of February, all day. It is with myself, Ryan, and of course, Michael. Some people are calling it Super Thursday because of the Bank of England and the ECB. I say people that call it Super Thursday need to go out and touch some grass. As usual, we give you a roundup of what's been going on in markets. We have a little bit of a ramble and a bit of a rant about whatever's on our minds. Disclaimers as usual. This is recorded live. There's no editing. There are trigger words thrown around willy-nilly. We are quite lax on the etiquette here at the Morning Blast. Nothing we say is trading or investment advice. Yada, yada, yada. Michael, how are we?
Well, a very good morning to you, Ryan. Good morning, everyone. I'm going to throw out the Super Thursday and I'm going to call it Damp Squib Thursday because although we're going to talk about the BOE and the ECB momentarily, I think, frankly, the most interesting thing out of all of that today will be whether my doppelganger is present at the press conference or not.
That handsome bastard with very not much barnet.
Which one?
Well, you're doppelganger.
Oh, I thought you meant me. Sorry.
No, well, you are, but that's why you're doppelganger. Don't worry about it.
It is like looking in a mirror. If people don't know who I'm on about, I'll put out a picture of him this morning.
I'll tell you about what is super.
What?
I'm going to be around after the ECB and BOE, so you can buy me a pint.
Ah, well, I'm not, so I'll buy you a pint tomorrow.
There we go. Hey, I know we're going to talk about BOE in a minute, but am I right in thinking you're still expecting it to be quite a divisive BOE?
Yes, but not as divided as it was in December.
Okay, cool. Okay. Right, let's crack
on. There you go. That's a little cliffhanger for you, isn't it? Stay tuned.
God,
it's like EastEnders. We could have the little drum beat coming.
Dum, 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 dum. I've got to say, though, if that's the highlight, if that's the excitement in your day, then you really do need to get out and stop listening to us.
Yeah, I'd agree with that.
Let's crack on. Update from our dear friend Clive Lambert at Futures Techs on where the markets are and what levels to keep an eye out for. Equities continue to trade in a bit of a chop. I don't necessarily think that's a bad thing. S&P posted a doji yesterday, which kind of sums it up. For those of you who don't know what that is, it's wicks, but just a very small body. So it moves around, but closes basically where it opens.
A bit like you, small body.
But a very long wick.
Oh, no.
Oh, God. Oh, no.
Fucking hell, this has descended, hasn't it? 4 minutes in.
DAX futures held support at 24,618. We've been talking about that of late, so it might be bit of cheer for the bulls. FTSE is the exception for now, with futures getting closer to the 10,466.5 yesterday. Another new all-time high, of course. Bonds, dull at central bank meeting today. Ditto FX markets. Bitcoin continues with its recent weaker tone, dipping through 70,000 this morning. Our next downside target is 58,000. We've been saying about that for a week or so now. Michael Saylor, penny for his thoughts. Oof. In the metal space, gold, the yellow metal, and silver have seen bigger moves lower overnight to prove the point that any recovery story isn't going to be a straight road. Must be said, though, it's still trading in the range that it's set over the last few days. So just treading water at the moment. Gold dipped to 48.05 where buyers stepped in. Silver getting all the way back to 73.41.5 where we've bounced twice now. Most other metal markets have also set a weaker tone since we last wrote yesterday. Brent, that rallied from a low bang on the Marabouzi support at 66.94 yesterday. So that should cheer the bulls and see us return to the recent highs of 70.58. Henry Hub, US Nat Gas, is trying to recover from Monday's rout. Obviously, that was weather driven. Free spot 640. Free spot 64. That'll do. It's a short-term Fibonacci level that we'd like to see retaken to suggest they're managing this. TTF, which is European Dutch Gas, another doji yesterday, also steady to ship, is open with a bid today. It's interesting to see that TTF and Henry Hub starting to trade with some sort of correlation. Not seen much evidence of that before. Maybe the world is getting smaller gas market-wise, according to Clive. Soybeans spiked up to 1,115 yesterday. Big move. 1,088 and 1,079 are now supports to watch. Obviously, there were resistance on the way up.
Although sources say an absolute bugger to trade.
Absolute bugger to trade, apparently. Sources do tell us that more people need to be getting involved in soy markets, and also retail brokers need to get more involved in supplying products. Not mentioning any names. Tom Wiseman. Tom. Well, was I? Soybean oil. Just for the one person out there trading it. Another bullish day yesterday, getting through that 550 level we cited yesterday. So now we can get gunning for 581 level as cited 24 hours ago. 551 is the Maraboutou support. That's it from Clive. Thank you, Clive. Michael, what happened yesterday?
Good stuff. Thank you, Ryan. Thank you, Clive. More of the same, I guess, is how I would kind of sum up yesterday, because, again, we're just looking at fairly chunky losses at a headline level, at an index level in the equity space. The S&P down 0.5%, the Nasdaq down almost 2%. But it's really under the surface where things remain very, very interesting indeed. This sector rotation, this churn that we see going on, investors continuing to come out of the tech names, continuing to come out of the software names and rotating into more cyclical stocks. And you'll recall, of course, during Tuesday's session, the S&P was down 0.8%, but 55% of the index closed green. Yesterday, we were down 0.5%, and 75% of the S&P 500 closed green. So again, at risk of sounding like a bit of a broken record on this one, I'm not saying ignore the moves at a headline level, because they are obviously important, but they are not telling the full story of what's actually going on under the surface, which is increasing signs that the rally is actually broadening out. And of course, the case for those cyclical names, for those real economy stocks, continues to be strengthened by incoming economic data. We had a better than expected ISM services PMI yesterday at 53.8 in January. That, of course, came after the better than expected ISM manufacturing print earlier in the week. And actually, if you look at Citi's Economic Surprise Index, which basically compares actual data to economists' expectations of that data, US data is now beating expectations by the biggest margin in 2.5 years, which again is fueling that sector rotation that we see taking place under the surface. Having said that, sentiment was a little bit shaky, particularly towards the back end of yesterday's session. There was some chatter doing the rounds that Iran had pulled out of the talks that were meant to be taking place between them and the United States tomorrow. However, about 3 hours later, apparently these talks were back on again, and that they are going to be taking place in Oman on Friday. This was after quite a lot of lobbying took place from various other Middle East leaders. So we will watch that story very, very closely tomorrow and into the weekend.
I'll say it's very important to keep an eye on these pull-out stories.
God, do you have to say it like that? Moving swiftly on from that, we also had news yesterday that Chinese President Xi had held a telephone call with US President Trump. Well, actually, I'm not even going to bother with the readout, because the long and the short of it is it was all very, very positive, but there was absolutely no real substance to anything that either Trump or Xi had to say. The only notable line was that apparently China is considering, that's the important word here, making additional purchases of US soybeans, which, unless you're Tom Wiseman, you probably don't care about anyway.
Just like a Tinder date with Michael Brown. No substance.
Where's that going?
No substance, but it was a positive overall vibe.
Right. Okay. Fine. Moving on very quickly from that. We also had the latest inflation numbers out of the Eurozone yesterday. Headline CPI coming in at 1.7% on an annual basis in January. Bang in line with expectations, but the lowest level since September of 2024. As expected, this was pretty much all driven by an energy-induced base effect. Energy prices actually fell by just over 4% on the year. The ECB likely to look through that, with core inflation remaining just above the 2% target. As for other bits and bobs yesterday, what else did we have? The ADP employment number was a little bit soft. That came in at 22,000 in January, down from the 41,000 that we had in December. We also heard from the Bureau of Labour Statistics, who confirmed that we will be getting the January employment report on February the 11th. So that is next Wednesday. They've also pushed back the January CPI numbers by a couple of days. So that will now be coming out next Friday, the 13th of February, which is bloody annoying, because I was meant to be out for lunch that day and I might now have to reschedule that.
Oh, no.
I know, honestly. If the BLS could just reschedule that again, it would be quite very much appreciated. Other than that, in the tech space, of course, we had earnings from Alphabet after the close yesterday. They delivered very, very strong profit and revenue metrics, although their CapEx guidance was ridiculous, to be honest with you.
Yeah.
They see capex in the financial year 2026 between 175 and 185 billion dollars. That's billion with a B. That's well above the 120 billion that markets have been expecting. Although I guess there are sort of two sides to this coin, because Alphabet fell initially about 7%. I think we ended about 2% lower after hours yesterday on the capex guide. But actually, the winners from that were companies like Nvidia and Broadcom, who actually rallied quite considerably
And why is
in the
that?
after hours session, because, of course, they're going to be the ones who receive all of that capital expenditure.
Someone yesterday, forgive me, I can't remember who it was. It might have been Citrini. It might have been one of the AlphaPix guys who are coming out on Friday, actually. So make sure you're coming out for Friday if you are in London for some non-farm pints. But basically, at what stage?
Non-farm pints, really. But
not non-farm pints. There we go. I'll say that after a couple.
After one.
Well, quite. They made the interesting point that these kind of capex numbers are so big. At what point does it kind of become kind of like private QE? Yeah, or this stimulus, because that is so much money that's coming back into the system from the coffers, or like being raised from wherever and getting put back into the economy. Or I say the economy depends on where they're spending it, but you see what I mean? Yeah.
Oh no, absolutely.
These numbers were now thrown around, like you said. We're talking billions with a B, and we're talking big numbers with a B. Yeah, these are bigger. These are bigger spending packages than entire governments were doing or are doing.
Yeah, it is insane.
Very much.
It is absolutely insane. The other thing is, at what point do these just become so big that the actual numbers almost don't really matter? I mean, we're talking about, as near as makes no difference, $200 billion of spending. If it's 190, 185, 180, like I'm not an expert on the tech space, as everyone knows by this point, but is there a material difference? Does 5 yards make that much difference when we're talking about 200 yards worth of capital expenditure? I don't know. I would wager it probably doesn't. The other couple of things I did just want to mention from yesterday is, firstly, the United States. They are proposing a trading block for critical minerals. This is also following on from that headline that we had in Bloomberg on Tuesday, forgive me, which was talking about how the European Union are looking at trying to propose doing a similar thing. Again, this is basically trying to reduce reliance and the dominance of China in the rare earth space. And we also heard from Senator Tom Tillis yesterday, who is arguably, from a market's perspective at least, one of the most important men in Washington, D.C. right now, because he, on CNBC, reiterated his opposition to confirming anyone to the Fed board while the Department of Justice probe into Jerome Powell and the Fed building renovations is continuing. And of course, this could be a little bit of a problem for Mr. Kevin Warsh, who is going to need to have his nomination progressed through the Senate. Obviously, you have you're not going to get any Democrat votes behind Kevin Warsh, I wouldn't have thought, certainly not on the Senate Banking Committee. So you need all 13 Republicans on that committee to be united in order to progress that nomination. And Tom Tillis at the moment is not going to be voting in favor of that. So I would imagine that the Department of Justice investigation is going to sort of go away in the relatively near future, because the alternative to not confirming Kevin Warsh is to have Jay Powell continue in post. And of course, Trump is not going to want that. But it is nonetheless something to just keep a bit of a beady eye on as we move through the next few weeks, and that sort of progresses in the background.
Absolutely. Absolutely. Thank you for that, Michael. Today, Bank of England, ECB, which one do you want to start with? Bank of England? ECB?
Yeah, we might as well, given that they're 100 yards down the road.
Yeah, given they're 100 yards down the road. So obviously the setup for this is obviously in December, Bank of England cut, it was a 5-4 cut, wasn't it?
Yes.
Daily swing. Consensus today is 7-2, I believe. Although I'm saying, in front of me, I'm saying some analysts, brackets Pepperstone, still see a 5-4 is possible. Is that what you've put in your notes somewhere?
It is, although I also put in that note that my base case is for 6-3. So
okay, well, split in the middle there. But anyway, for the setup,
true sell side analyst fashion. I'm just hedging.
I was going to say, did you also throw in a 7-2 as a possible?
Yeah, I also said that Dingra might pull a sickie, so it could be 8-1.
Oh, there you go. I love it. Well, obviously, speaking of Dingra, so it's Dingra and Taylor are the likely to be voting for a cut on hold. Obviously, it's Green, Lombardelli, Mann, Peel, Bailey, Breeden, etc. But the setup is obviously from December's cut. December's inflation uptick to 3.4%. 3.3. 3.4 killed any chance of February cut. The MPC will hold at 3.75% today with a focus on the quarterly monetary policy report and how divided the committee remains. Labour market deteriorating fast. Unemployment at highest level since 2001. Though don't tell Tris Osborne, he won't believe you. Payroll employees down to 184,000 over the year to December. Well, no, sorry, down over 184,000 over the year to December. But inflation is still well above target. Bailey's quote gradual downward path that he likes to talk about language that will likely remain, but the real signal is in the forecasts. If they penciled in 2% inflation by mid 2026, March or April cuts are back on the table, is my opinion. What's yours?
My opinion is exactly the same.
Oh my God.
I know, that's fucking worrying.
I gotta say, like, everyone says to me how they're quite impressed I've created a monster in terms of your drinking habits and whatnot. But I got to say, I've also had people say to me, Michael is definitely rubbing off on you. Not like that, because Ryan is starting to do more research to actually care about what he's talking about.
I know, I am quite proud about that. But yeah, I think that is exactly how I would be sort of looking at the BOE today. I think it's a meeting that's all about the guidance and it's all about the forecasts. And as you said, the guidance is likely to be unchanged from that which they issued at the December meeting, talking about this gradual downward path for bank rate, which depends on the evolution of the inflation outlook. And actually what the MPC are doing there is actually doing everyone a bit of a favour, because they're literally putting in black and white what they are looking at, the inflation outlook. It is, we were mocking it earlier, but it is a super Thursday meeting. So we will be getting that updated round of economic projections. As you rightly say, they are likely to pencil in a return to that 2% inflation target in the second quarter of this year. I think currently, according to the November projections, they did see inflation at 2.9% in the second quarter of this year. So that's likely to be quite a significant move lower in terms of that inflation profile. And then inflation is likely to remain at that 2% level over the remainder of the forecast horizon. So I think today is very much a meeting where it's not necessarily about what the old lady does right now. It's more about what they do in terms of laying the groundwork for a rate cut either in March or at the April meeting.
Yes.
The other thing I would say about the bank is I'd argue that, we're kind of again joking about the vote split. I don't think the vote split actually matters too much today. It will cause a little bit of knee-jerk volatility in the pound and in gilts as all of the headlines cross newswires at lunchtime. However, the fundamental fact of the matter is we know that there are 5 votes on the MPC at least that Andrew Bailey can call upon when he wants to deliver another rate cut, because that's exactly what they did in December. That's exactly what they did in August, even back to August of last year when they delivered the cut before that. So whether it's 7-2, 6-3, 5-4, the facts of the matter are that, when the governor wants to cut, he is going to be able to bring Breeden along with him. He's probably going to be able to bring Ramsden along with him. Dinger and Taylor are already in that camp. So actually, I don't think we're going to learn too much from the vote split. I think if you look at one thing and one thing only over the BOE today, just have a laser-like focus on the 2026 CPI forecast.
Yeah, well, quite. And I think it's a very important point to make. It's akin, where kind of I liken it to non-voting FOMs, non-voting Fed chairs, that when they're not voting, they get to kind of say whatever they want and they can...
They've got a free pass.
Exactly. And to that extent, you can almost say it's like this on a meeting where we know it's a dead rubber, we know it's going to be a hold. It means that MPC members that want to project what their underlying feel is, because they know there's no danger of it impacting monetary policy, they can, vote the way that kind of almost to give them a bit of to telegraph what they're actually thinking inside. But as we know, when it comes down to it, when, as you said, when Bailey says, look, guys, we actually do need to cut this meeting, they will just side with the governor.
Yeah, absolutely. And I think that's the important takeaway from that. Shall we do the ECB as well?
Let's do the ECB. So the setup for the ECB, Lagarde said the ECB is in a good place in December, and there's nothing, that's one of her favourite phrases at the moment, is in a good place. And there's nothing has changed since then. January inflation came in at 1.7%, actually below the 2% target for once. Core inflation at a 4-year low at 2.2%. This is the 5th consecutive hold since June 2025, when rates reached 2%. Unlike the BOE, the ECB has achieved something close to a soft landing. Inflation at target target, growth stable, although low, and unemployment low. The weird situation, some ECB officials have kept the door open to potentially hike rates in 2026, not cut, obviously looking over to the Reserve Bank of Australia. BNP Paribas, the majority view, sees the next move as a hike in Q3 2027. So again, it could be a year of very, very little, going on in Brussels.
Yeah, absolutely. I mean, it is very much going to be a case of, as you were with the ECB today, I think there is absolutely no chance whatsoever that they alter the deposit rate from its current 2% level. And there's basically no chance that they change the statement either. Again, sticking to this guidance around being data dependent and taking a meeting by meeting approach. Frankly, it's basically because there's not likely to be much of interest. This ECB meeting has all the hallmarks of one where the sort of usual suspects will pour over everything and sort of find messages that aren't really there in, the fact that Lagarde moved her eyebrow in a certain direction or whatever it may be. I'm really not expecting.
What brooch is she wearing? That kind of thing.
Yeah, all that kind of nonsense. I'm not expecting anything sort of groundbreaking from the statement, certainly not from the press conference either. There are going to be a few potentially spicy questions. Lagarde is going to be asked about her thoughts on the recent strength that we've seen coming through in the euro.
So sorry, just on that, because I'm so glad you said that, because I've actually highlighted that as being basically pretty much, I'd say, the only problem that they've got at the moment is the strength of the euro, right? It's like it's tested 120 in January, which is the highest level since 2021. It could import deflation if things will pan out the way they potentially could. Strong euro suppresses import inflation, gives Lagarde some breathing room, but obviously the downside is that export competitiveness, especially German industry, suffers. So Germans want they want it to go down. But with all things considered, and including when you look at how fractured politically the powerhouses of Europe are at the moment, I think Lagarde would say, do you know what? The strength of the euro is really the least of my concerns at the moment. When everything else is running correctly or running smoothly within reason, as much as the Eurozone experiment can, I don't think she's going to be too worried about it.
No, I would agree. And I think, I was looking back earlier on at the December press conference and also the October one before that. The line that Lagarde typically uses around the exchange rate is simply, we don't target the exchange rate. And I think we're just going to see a repetition of that at the press conference today. Yeah, really not expecting anything by way of wave-making news, to be honest. Although do, of course, to just bear in mind, because it is an ECB decision, we might get some sources stories as the afternoon progresses. In fact, it's almost a given that we will get those sources stories. If I was a betting man and I was asked to suggest what those sources stories may be, I would say one of them, probably either Bloomberg or Reuters, will be along the lines of the ECB staff think that the easing cycle is over and now at an end. And if there's a second one, then it could be something along the lines of the ECB's more dovish members may seek to make an argument for a cut in March, depending on the staff macroeconomic projections at that meeting. So there you go. There's tomorrow's news today from my desk. I don't think either of those should be particularly market moving because they're not really anything new. It's
Doves calling for ultra Doves calling for a cut. Nothing new, is it? You know what I mean?
No, again, if you look at the sort of dispersion across the Eurozone, someone like Villeroy, the French central bank governor, of course he's going to call for a cut. His economy's fucked and he's at 120% of debt to GDP. Yeah, right. Whereas you look at, for example, Nagel in Germany, why the hell do you need a rate cut? So, there's nothing new there.
No, exactly that. Exactly. One to flag our good friends over at EconoStream, that their Twitter handle is actually at EconoStream. They are very, very good ECB watchers. So definitely one to follow there if you have an interest in the ECB. But no, hopefully we've added some value on the ECB and the BOE. Apart from those central bank decisions, what else have we got to look forward to today?
Yeah, just a few other things on the calendar today. Of course, those policy decisions are the sort of main event. We do have some US data, though, at 1:30 this afternoon. We'll be getting the weekly US jobless claims numbers. Note that neither of these pertain to the January non-farm payroll survey week. Initial claims expected to have held broadly steady at 212,000 in the week to the 31st of January. Continuing claims expected also broadly unchanged at 1.85 million. Do just bear in mind mind that although we didn't see it last week, there is still the potential for some noise in that data around all of the cold weather that we had in the United States. So if there is any uptick, then that's likely to be the cause for it. The way you can kind of try and gauge whether that's the cause, look at the state level data. The states with the biggest increases in claims are probably going to be the ones that were most affected by that winter storm. We also get the December JOLTS report today. That will be released. Of course, it was due for release on Tuesday, but it's coming out today as a result of the government shutdown. And it's also another busy day on the corporate earnings front as well. Before the market opens today, we hear from ConocoPhillips. They highlight the earnings docket. And then after the market close, Amazon, they will be the standout report. They are due to report pretty much bang on the closing bell. Of course, focus will fall largely on two things. Firstly, the resale side of the business. How did that perform over the festive season? Did Amazon have a solid Christmas period? Also Thanksgiving, of course. And secondly, probably more importantly, is the AWS side of the business. What are they saying in terms of revenue and guidance in terms of web services, particularly as the market begins to take something of a more skeptical view around the whole AI theme? Amazon have fallen after hours following 3 of their last 4 quarterly reports, although, of course, past performance is not an indicator of the future, etc., etc., etc. However, this time around, options on Amazon stock price a move of around 7.5% to either the up or the downside after that report this evening. So certainly one to watch, not only if you have exposure to Amazon stock, but also as a sort of broader potential spillover effect into indices and other names in the tech space, as we saw in the aftermath of that Alphabet print yesterday.
Wonderful. Well, Michael, thank you so much as usual. Listeners, thank you so much for tuning in. Hopefully you've added a bit of value to your day. Maybe put a smile on your face. I don't know. Come and see us for some jokes if you want some smiles on your face on Friday. Watching Michael Brown drink 2 pints of beer and then be absolutely shit-faced is always worth a laugh. And,
selling too.
And I'll get ID'd for a shandy. So that's normally how these things go. So come along on Friday if you are around in London. Give us a shout out if you want to know where and when, etc., etc. But yeah, whatever you're doing today, keep